My dad made over $1 million trading this simple strategy, and it's the same one that made me my first $100,000 day trading in the stock market. In this video, I'm going to break down exactly how it works, how to execute it, and how to instantly start using it to 2x, 3x, even 5x your trading profits. No, I'm serious. This is a fundamental strategy that should be a staple within your trading plan, and this is a no bullshit guide on exactly how I use it every single day to make money. To prove to you that I actually make money with everything that I'm going to be teaching you in this video, these are my last 6 months of personal brokerage statements. I use Charles Schwab, Think or Swim platform, and in the last 6 months, I made a little bit over $370,000 between November of 2024 and April of 2025. And as soon as my May statement is ready, I'll be posting it in here for the next video. And the reason I'm showing you these statements is to be as transparent and as real as possible. I've had a lot of people in my comments ask me to show you my results from my actual brokerage account. So I'm happy to do that for transparency purposes. I'm going to go ahead and refresh the screen. And if we go to November of 2024, November 1st to April of 2025, as you can see, like I said, I made a little bit over $300,000 and I had a cumulative rate of return of 186%, nearly 3x on my entire portfolio in that 6-month period. I would never teach you guys anything that I don't personally use in my trading every single day. And what I'm about to show you is my personal favorite trading strategy. I literally trade this setup every single day in the markets. Ultimately, because of its simplicity. One of the reasons I am a profitable trader is because I like to keep things simple. I think the simplest things in life are oftentimes the most brilliant, and that 1000% applies to trading. I see so many unprofitable traders out there that struggle because they overcomplicate their trading. They use fancy strategies, crazy indicators. They use those buy and sell markers on their charts, and they just overcomplicate their analysis. And what I'm going to show you is a fundamental strategy that I guarantee you've heard of. I guarantee most traders have heard of this, but only a small percentage of traders actually succeed trading this strategy, and I'm about to tell you why. And this setup, ladies and gentlemen, is, drumroll please, the base breakout, the base breakdown. And you might be thinking, oh yeah, I've heard of breakouts and breakdowns. Maybe I even trade breakouts and breakdowns. And you might be thinking, oh, don't all base breakouts fail? Like, that's a common thing I always hear. Oh yeah, breakouts fail. Well, yeah, there are thousands of breakouts and breakdowns that occur every single day in the markets. But our goal as traders is to only trade the highest quality of breakouts, right? The ones that are going to have a high reward to risk, that are going to be high probability, that are going to be high quality. And we want to avoid the low quality breakouts and breakdowns. And in this video, I'm going to explain exactly what to look for, what criteria to follow, how to identify high quality breakouts versus low quality breakouts. And this is ultimately what's going to make you profitable trading this strategy. If you're able to find what's called amplifiers, and amplifiers are essentially, criteria that make a specific setup higher quality. And I'm going to go over every single amplifier for the breakout and the breakdown. But step one for trading this strategy is you need an established uptrend for a breakout, and you need an established downtrend for a breakdown. This is really, really simple, right? What's an uptrend? Higher highs, higher lows, right? So what does the uptrend tell you? Well, uptrend tells you where prices are heading, right? And we as traders want to trade in the direction of the trend, right? You could be a reversal trader, but for the purposes of the strategy, we want to be trading with the trend. I mean, think about it. If you're driving on the freeway, on the highway, do you want to drive in the direction of traffic, or do you want to drive against it? Well, if you drive against the flow of traffic, well, that can be very dangerous. The same thing with trading. If you trade against the trend, that can be very dangerous. And once you've identified that there's an uptrend or a downtrend, great. You need to understand why the breakout even exists. Like, what's the concept behind the strategy? And to understand that, you need to know what price correction is and what price correction is within an uptrend or a downtrend. So let's get into it. So I want you to imagine that you just ran a marathon. Literally, imagine you just ran the New York City Marathon, what's that, like 25, 26 miles, right? Think about it. You just finished the marathon. Would you be able to immediately run another marathon? So you just ran 25 miles. Would you be able to run another 25 miles? Well, unless you're David Goggins, you need to rest. You need to sleep. You need to eat. You need to hydrate yourself. You need to relax. You need to, get some rest, right? And the markets move in very similar ways, right? Unless you're David Goggins and you could just run marathon after marathon, you need to rest before you can run the next marathon. Well, the markets move in a very similar way. Whenever prices run a marathon or have a big rally, it can't just, run up forever. They can't just move up, like to infinity, right? Prices also need to rest. And you could think of this resting period as like a correction, right? Prices need to correct before they can run the next marathon or before they can have the next rally higher, right? And there are two ways in which prices can rest or correct. These are the only two ways. Either a retracement where the market runs a marathon and then it rests and corrects through a retracement. This is kind of like a buy the dip, right? That's the theory behind buy the dip, right? You get a big run up and we retrace, we correct, and then we get ready for the next marathon, for the next rally higher. The other way in which we can correct is through a consolidation, right? This is when you literally rest, right? The markets move up, they rally, and then they just stay at the same price. So the definition for consolidation is a period of time when the stock is trading within one particular range. It's not moving above that range. It's also not moving below that range. It is literally resting within that range. So these are the only ways in which prices can correct, in which prices can rest. And you probably are already getting, ideas of like, oh, I get this, right? Within an uptrend, prices are moving higher and we find corrections within an uptrend, and those are opportunities for us as traders. And you're absolutely right. And that's what we're going to go over right now. In other words, by trading a retracement, by trading a consolidation, in other words, trading a, correction pattern, you're trading the continuation of an established trend. And in my opinion, that's the easiest way to make money with trading, to trade the continuation of an established trend. Always remember that the trend is your friend, and our goal is to spot retracements and consolidations or breakouts within established uptrends in order to make money. So hopefully you're starting to see this. And if you want to learn how to trade the retracement pattern, I actually teach it in my free 10+ hour course. You could find that in the description of this video. My free course is genuinely better than most paid courses on the internet. So it'll build the foundation for your trading, and you could use a lot of what I teach in my free course in conjunction with my YouTube videos to solidify that trading foundation of yours and actually begin making money. So next, what I'm about to talk about is very, very important, and that is your entry and your stop loss for the base breakout, for the consolidation, which is what we're talking about in this video. And this is especially important because as traders, it's important to have structure within your trading. I see so many traders out there who have random entries, random stop losses, random targets, random execution, random management, and nothing in their trading is predetermined. They don't have structure. And yeah, I see people online all the time that are like, yeah, I'm entering here. And there's no reasoning behind that entry. So with this breakout setup, you're going to know exactly where you're going to enter and where you're going to be placing your stop loss. And theory behind the entry and stop loss is as the stock is basing and consolidating, right? You could think of the top of the base as like a resistance area, right? It kind of retests that top of the range and it retests the bottom of the range. So the top of the range is going to act as a resistance area within this consolidation. And the lows of this range, the lows of the base is going to act as a support area. And the reason that theory is important is because for the base breakout, we want to time our entry as prices are breaking out of that range, as they're breaking through that resistance, which is, at the top of the range. And we want to be placing our stop loss below the base, below the range. In other words, below the support area at the, bottom end of this base. So entry over the base, stop loss under the base. That's just an easy way to think about it. It's extremely simple. And just having this entry and stop loss model within your trading, you're already ahead of like 70% of traders who just operate completely randomly. So always remember, you have a base breakout, entry over the base, stop loss under the base. If it's the opposite, if it's a breakdown, it's entry under the base, stop loss over the base. It's very easy, right? And with having a predetermined entry and stop, it's going to make your life a lot easier when it comes to risk management, which we're going to get into in a second here. So easy enough, entry over the base, stop loss under the base. All right. Next, we have the 20 period moving average requirement. And I actually made a separate video a couple weeks ago about the 20 period moving average and how I use it. So I recommend actually watching that video after you watch this one. But essentially, for the 20 period moving average, for the uptrend that we've already identified for this setup, we want the 20 MA during the uptrend to be under prices trending lower. We want trending higher. So we want a rising 20 MA that's trending higher, under price trending higher, under price trending higher, under price trending higher. That's what we want to see for the 20 MA, right? So we see this really nice uptrend. We want the 20 MA to be under price trending higher. And if you watch the 20 MA video, you'll see how well prices respect the 20 period moving average within trends. And the opposite applies for a downtrend. The 20 MA is over price trending lower. And that's exactly what we want to see for a downtrend. Over price trending lower. All right. So opposite for a uptrend. Next, our goal is to look to buy when prices are close to or near the rising 20 period moving average for a breakout, right? So we have that initial rally, the initial move up. At this point, we're extended, right? If you watched the 20 MA video, we're extended from the 20 period moving average. You could think of this as we're overbought. And from there, we need to rest. Prices need to correct in the form of a consolidation. And that's when we rest, we correct into that rising 20 period moving average that is under price trending higher. And we want to be timing our entry with the consolidation, with the base breakout when prices are close to or near the 20 MA. And this is exactly where we want to be timing our entry right here. All right. So easy enough. This is literally the only indicator I really use is the 20 period moving average and the 200 period moving average. Now the 20 MA, it's crucial for this breakout pattern. All right. So very important. You want that rising 20 MA. You want to see it consolidate into that rising 20 MA. Or if it's a downtrend, you want to see it consolidate into the declining 20 MA. All right. Now, one extremely important factor when it comes to the base breakout or base breakdown is the quality of the consolidation. We want to see tightly ranged consolidations. We want to see them tight. We want to see them almost like in a tight range. We don't want sloppy consolidations, and we don't want a lot of bottoming tails or topping tails. And I'll show you what that looks like in a second. The tighter the base, the tighter the range of the consolidation, the tighter the stop loss, therefore the better the reward to risk. And I'm going to explain how that makes sense, right? So what we want is a tight base here. Let me kind of zoom in, right? We don't want a sloppy base. We want a base that's tightly ranging, and then we trade the breakout. We don't want it to be, all over the place, and then we trade the breakout, right? We want tight bases. And this is why, right? It all comes down to your reward to risk. So right here, we have two different consolidations, two different bases. This one is very tight, very clean. It's not ranging all over the place. This one is the opposite. It is ranging all over the place. It's up, it's down, it's up, right? So let's say our entry for both of these setups is $3, right? Over the base, $3 for both of them, right? However, let's say our stop loss for this tightly ranged setup is $2.90. However, our stop loss for this, sloppy consolidation is $2.70, right? Because it's a wider base. You're going to have a wider difference between the entry and your stop. If we're risking $100 on both of these trades, right, what would be our sizing? And we're going to be using this formula, which I talk about in other videos. It's essentially your risk divided by your entry price minus your stop loss price. This is how you size your positions. This is how many shares you need to buy for that position. So if it hits your stop loss, you only lose your predetermined risk. I talk about this in other videos as well, and in my free course in the risk management section. So watch that. Right, but let's say $100 risk divided by what's the difference between the entry and the stop, right? $3 minus $2.90, that's a 10-cent stop. $100 divided by 10 cents is 1,000 shares. So for this breakout, we're able to get 1,000 shares. However, in this case, since we have a wider stop, instead of it being 100 divided by 10 cents, right? $3 minus 270, that's 30 cents. It'd be 100 divided by 30 cents, which is 333 shares. You're risking identical amounts of money in these examples. You're both risking $100 on both of these setups, right? It's the identical risk. The risk remains constant. But what changes is the amount of shares you can get. And this obviously has just a way better reward to risk. You're able to get more shares on the same risk because you have a tighter stop. And the reason you have a tighter stop is because you have a tighter consolidation. You don't have a sloppy consolidation like you do here, right? This is why we want tight ranges, tight breakouts versus, crazy and sloppy breakouts like this, all right? And overall, when you have a tighter range, tighter consolidation, you end up getting way better continuation on that setup as well. So that's also really important. So here are a couple of examples of very sloppy consolidations, right? Like you're seeing this, it's like up, it's down. Let me get the different color here, and let me make it super thick. Okay, you see it's up, it's down, up, down, right? It's all over the place. You could see that during this base. It's like sloppy. Even during this, like we're up, then we're up. It's not tight. It's a very sloppy base. So these are good examples of sloppy bases. These are good examples of what you want to avoid. Even right here, right? Let me get the black one out. Right here, you get the move lower, you retrace, and you see how sloppy it is. It's all over the place before you break down, right? So in this case, the entry would have been below the base, stop loss above the base. But that's such a big stop because it's such a sloppy setup. All right, does that make sense? So in summary, you want tight ranges, a tight consolidation for better reward to risk. All right, makes sense? Now, let's go ahead and just look at some examples of this, right? So that's the strategy, right? We got the 20 MA requirement. We know where our entry is. We know where our stop loss is, and we know we want tight ranges, tight consolidations. Let's take a look at some examples here. All right, so this first example is actually Ethereum, and this was literally just a few weeks ago. Take a look at this breakout right here. So Ethereum was on a multi-month downtrend, and then all of a sudden we bottomed here, then we based, and then we kind of had that initial breakout over the base. But this wasn't the interesting one. This was the interesting one. So we move up, and then we consolidate right into that rising 20-period moving average, and then we pumped like 40% on Ethereum. And you could see how tight of a range this is. It is such a tight base. So that's where your entry would go. It'd be over the base. You could put your entry here or over the base here. Stop loss under the base right here. And that would be your entry and your stop. An unbelievable breakout opportunity. Literally on Ethereum, almost picture perfect breakout on ETH. And I was actually buying a ton of it throughout this entire area. I'm very, very bullish on ETH, not only from a price action perspective, but long-term as well. Here's another really, really good example, right? On APLS, we kind of started to, we moved down a little bit, and then we started to base into the rising 20-period moving average. I think this was on a gap up, which I'll talk about in a second. So this thing gapped up and then just consolidated. And really, really clean. Entry over the base, stop loss under the base, and you would have caught that move. Very, very nice. Let's move on. This is another really, really beautiful setup. I mean, take a look at how tight the base is. Not sloppy at all, like right here, right? Take a look at this. We dropped, we retraced. So it's kind of like a retracement pattern as well. And then we consolidated, then entry below the base, stop loss above it, right? Beautiful, beautiful breakdown, right? You know, maybe not right into the 20-period moving average, but remember, it doesn't have to be exactly at, it just has to be near the 20 MA. And I consider this pretty near the 20 MA. So excellent, excellent setup. I actually made money on this one. So all these trades are trades that I've taken before. Here's another really, really excellent example as well. Check this out. Consolidation, breakdown, right into the 20 MA, entry under the base, stop loss below. Then we dropped, consolidation right into the 20 MA. We got a breakdown, entry below the base, stop loss above. And that thing just I mean, from what? 90 bucks all the way to like $63. Insane move, right? And it's simple, right? We're essentially just trading the continuation of the trend in a really, really intelligent way, right? Let's look at an example actually from yesterday's trading. So let me point exactly where this was. So this is the 5-minute chart, and a lot of people might be wondering, hey, what time frames do you use for the breakout breakdown? It's all about using multiple time frames. I'm probably going to make another YouTube video about this, but it's not about using one time frame. It's about practicing multiple time frame analysis, and you are looking for multiple time frame alignment. So if you look at it, this was at around 12 o'clock. It started to base, right? So this thing dropped the entire day and then kind of, you know, did some sloppiness right here, but then it started to drop and then it started to actually consolidate really fluidly. Now this was on the 5-minute time frame. So this kind of set the bias here, right? The 15 and the 5 set the bias that this was downtrending. And then right here between 12 and 12:30, so this area right here, I actually screenshotted the 1-minute chart. It was between right here all the way to right here. You could see on the 1-minute chart, look at how well prices are respecting the 20 MA. And check this out. We have a base breakdown. We based right into the 20 MA, small little breakdown, continue to base, small little breakdown, continue to base, small breakdown. And then this is where it really accelerated, where it based, look at this, such a tight base. It wasn't like this. It was literally like a very, very tight base and then breakdown, right? Very tight base, breakdown, then based again, breakdown, braced again, breakdown, based again, breakdown. This is what I call a stair step, where you drop, base, drop, base, drop, base, drop. Or the opposite, where you go up, base, go up, base, go up, base, go up, base. This is a stair step. If you ever see a stair step, it's literally some of the easiest money that you can make in the markets, seriously. And unfortunately, I actually missed out on this. I was away for lunch at 12, and I only came back at like 12:45, not even at 12:50, so I was already late to the move. But unbelievable setup, honestly, unbelievable. And this was literally yesterday, right? So it's important to look at multiple time frames. And yeah, just beautiful. You know, you can see how well it's respecting the 20 MA. And this is what I do every single day. I find established trends, and then I find breakouts and breakdowns within trends by using the 20 MA, by, of course, looking for really, really quality setups, tight bases. And then from there, I'm looking at multiple time frames, and I'm also using level 2, which I teach in other videos. So yeah, and this is exactly how I do it. Now, there's also another very, very key amplifier that you could use when you combine these setups with gapping stocks. Now, what is a gapping stock? That is an overnight change in price. So a stock, you know, closes at $5 yesterday, and then the next day it opens at $8. That $3 difference overnight is a gap. It's an overnight change in price. You could literally see the gap in the chart. And I trade gaps. I'm a day trader. I love trading gaps. And the gap sets the bias, and then from there, I usually trade that bias through a breakout on the intraday timeframes, which I'm going to show you a bunch of examples in just a moment. And 80 to 90% of the time, I'm trading in the direction of the gap. There's this idea that all gaps fill. Everyone will tell you that, oh yeah, don't trade gaps. All gaps ultimately fill. Maybe long term, you could find me a statistic saying that all gaps ultimately fill the gap, over a course of a year or two. But in terms of the day of the gap, yeah, there are some gaps that fill, but there's a ton that follow through and continue with the gap like crazy. I've been trading gaps for 5 years. This idea that all gaps fill and that you should not trade gaps, that is nonsense. It is bullshit. I'm going to show you examples of it right now. I trade gaps for a living. I trade the continuation of gaps, meaning if it gaps up, there's an overnight change in price to the upside, I usually go in the direction of that. I go long during the intraday. Or if it gaps down, overnight change in price to the downside, I usually go in the direction and I'll look to go short. I do this 85% of my setups are that. So that is bullshit, that all gaps fill. It's not true, it's a myth. So, and this is what I do. The gap establishes a bullish bias if it's gapping up on the higher time frames, and then I trade that bias on the intraday time frames via a breakout or a breakdown. And the reason gaps occur is because of news, earnings, events within the company. There could be all sorts of reasons on why prices change overnight. I'm not really concerned with the reason. I'm concerned with what that gap is doing to price. I actually have another video on my YouTube channel. This strategy is boring but makes me $50K a month. That video goes over gaps, and I go over how I combine gaps with this strategy as well. So let's go over a couple from the last few days. So I've had people comment under my videos saying that I cherry pick specific charts from like years ago that, perfectly represent the ideas that I am teaching. But all the stocks that I'm about to show you are ones that I've either made a lot of money on over the last literally like 2 to 3 weeks, or stocks that were on my watch list, they were on my radar, and maybe I just missed them. But most of these stocks I actually traded and made money on. The first one was Open, and I used the replay function just to make it less confusing and kind of go back to the specific day which this happened, which was on May 9th, which was just a couple of weeks ago. So Open closed at 87 cents the previous day. The next morning, it gapped and opened at around 70 cents, 69 cents, directly below this downtrend, below support, below into all-time lows. So since we were clearing support and gapping down, that gave me a bearish bias. And then if you go to the 5-minute chart, you see just a few picture-perfect breakdowns here. So at first, it actually got bought, then kind of settled down, and my first entry was right here, caught this move lower. And then I exited, took profits, and then I started shorting it again right here on this base, dropped, based, and then look at this flush lower. This was my biggest trade on that day. I think this made me in total $4,600, something like that. Insane breakdown. It was beautiful at the time. And this was on such a tight stop. Literally, it was a penny stock and there was no spread. The stop was like 0.0002. It was like insanely tight. So I got massive size. I had like 100,000 shares in this thing. All right, so this was a really, really perfect example of that. Here's another fantastic example on Coinbase. This was on May 13th, and this was actually my biggest miss of the week. I got shaken out of this trade, and I wasn't able to fully capitalize on it. I will be transparent. It made me, it was just crazy. It was crazy. This next one is on Coinbase, and this was on May 13th, and this was an unbelievable play that unfortunately, I will be transparent, I missed out on. I mismanaged this and I wasn't able to capitalize, but take a look at this. We bottomed at around 144, then we started to kind of chop around. We had that rising 20 MA. We closed at 206 the previous day, and the next day we gapped up around 12%, which for Coinbase, it's a $200+ stock. That's pretty significant. We gapped above this entire resistance area, right? So let me get the tool. We gapped above this entire resistance, and we also gapped above the 200 period moving average. And we had we had no resistance until literally like probably this pivot, even it could have even gone higher. We had literally absolutely no resistance. It was an amazing gap up. So I saw the gap, and this gave me a bullish bias. Then you go to the intraday time frames, let's say the 5-minute chart, and you could see just a beautiful breakout right here. You could have played over the highs, stop loss below, and what that's at 240, 250 entry, 238 stops. It's like a $4 stop, and this thing ran to 260. So it's like 4 or 5 Rs, and you could have even used a tighter stop as well. And in fact, there was an earlier entry on it right here. You could have said that, hey, rallied, based a little bit. I remember I called this out in my group. I had a bunch of students that printed on this, but I mismanaged it. Anyway, that's fine. I know exactly what I did wrong, but you could have entry over this base, stop loss above. Oh, I'm sorry, stop loss below. So entry over the base, stop loss below, and then you could have even added to it over this base and then moved your stop loss up. So it was a fantastic, fantastic example. And you can even see how well prices were respecting the 20 MA on the pullback, on the retracement, right here, here, here. It was an amazing just power trend that day, ignited by the gap. So the gap gave me the bias, and then we traded the bias of that gap via a breakout on the intraday timeframes. Here's another unbelievable gap and example. The previous day we closed at 232, and then the next day we opened at 188. So what, this was like about a 20% gap, and we were gapping directly below the all-time lows, directly under support. We were gapping directly below this move higher. It was beautiful on this DCGO. I think I used this example in the other video just because it's a picture perfect gap. And it was a really nice setup on the intraday timeframes as well. And I was able to capitalize. I don't remember exactly how much I made, but I remember I made at least, I think it was 1,000 to 2,000, something like that. And you could see the breakdown right here, where we dropped, then we kind of retraced, moved back in, and then we had a breakdown setup right here. It's probably a little bit cleaner on the 15. You could probably see it a little bit better. Yeah, so we dropped, we based, and I remember this stock, it was hard to get filled on a lot of the times, but entry below the base, stop loss above the base, right? And I think there was there was another base breakdown, the smaller time frame. Yeah, the first one, it's gonna look really weird on TradingView. On my Thinkorswim platform, it looked a lot cleaner. It's gonna look super wild. It didn't look like this on Thinkorswim, but that was actually my first setup on it. I stop loss here, and then entry under the base, and then we caught that move lower in my group. And that was fantastic. That was a fantastic play. So same thing, unbelievable daily gap down, which set the bias that it was gonna go lower, bearish bias. And then we traded that bias on the intraday timeframes via a 15-minute and 2-minute breakdown. This video is getting long, so I'll do one more, and this was on Wolf. This was my biggest trade last week. I remember distinctly because it was pretty recently. This was May 21st, so it was only like a week ago, literally. So I made, I think, $5,600 off the Wolf. And by the way, I post all my results every single day on my Instagram story as well. So I highly recommend following me on Instagram to see my daily P&L. So this thing gapped down a lot. It gapped from what, 312 all the way to like 110. It was like a 60% plus gap. I call this kind of like a mega gap, where it's a massive, massive gap. And whenever you have massive gaps like this that are, 60, 70 plus percent, they can actually go either way, right? I usually would have a bearish bias on a gap down, but when you have a really big gap down that's really under support, right? Like this was super under support, it could actually get bought. So we'll go to the intraday timeframes, and you're not going to see this because I did it off level 2 as a scalp, but off the morning I got 5K shares at 110, stop loss 115. So I was only risking like $250, and I was able to kind of manage this, and I took profits around 92 cents. So off my first trade on it, I made like $750 off level 2, and I kind of scalped it lower and held it and took profits around here. But the real trade in the breakout was right here. So this thing dropped, ended up bottoming at around 82. I was scalping this on the way up, but off level 2, but that wasn't the real trade. Right here, we moved up, we started to base, rising 20-period moving average, entry above the base, stop loss below the base, and I actually sized up. My risk is definitely discretionary. Sometimes I size up on really, really high quality setups. I sized up on this one, it also had a really nice level 2. So I got in around 103, 104, something like that. I think my by the end of it, my average price was 105. I had like 25,000 shares. I sized up. And I got in using level 2 as well. But the entry here is really breakout entry above the base, stop loss below. And I caught this move higher. My first exit, I remember, was at 118. So I had 25,000. I took profits at 118. And then you see this little tail right here. We got back in off level 2, scalping it. And there was a retracement on the intraday time frame. So we got back in at 112, rode it to 125. And then I think we had one more move on it. But by the time it hit 140, I was more or less out of my full size. And this was a beautiful breakout as well. So the idea here is we use gaps to set the bias, and then we trade that bias via the breakout or breakdown on the intraday time frames. Hopefully this makes sense. Video's getting a little bit long, guys. Hopefully, you could begin applying this in your trading and use all of these things. So in summary, we used the gap. We looked at a bunch of examples of really clean base breakouts, right? We don't want to see sloppy bases. We want to see clean, tight ranges because they give you a better reward to risk, and it also gives you better follow through. The less sloppy, the better it is, right? So that's what this covers. And then from there, we used a 20 MA to our advantage. Watch the 20 MA video. We wanted under price trending higher for an uptrend. We want to see prices consolidate into the rising 20 MA. And of course, you understand the whole price correction thing. It's a very, very simple strategy. Like, you're probably looking at this video like, yeah, this was really simple. This is what I do every day. This is by far my most profitable strategy. And it's the first one that my dad taught me. All right, guys. So very good. Make sure you like, make sure you subscribe, make sure you leave a comment if you enjoyed this video. And I actually am a little bit sick. It took me like a few hours to record this video. I'm a little sick, but hopefully you really enjoyed it. And if you're someone who's looking for a hands-on mentor, you want to trade live with me every single day, you want me to take you under my wing, teach you from A to Z, and scale you from $0 to $10,000 to $50,000 a month with trading, that is exactly what I do with my mentorship students. I scale and coach them to become profitable traders and ultimately full-time traders. That is the purpose of the mentorship, is for you to change your career and become a full-time trader. And I help you do that. I'm very selective with who I work with. So if you're interested, if you want more details, if you're really looking to take that next step in your trading, there's an application below. There's also a video in there that'll give you all the details. You could apply, book a free call, no pressure. We'll see if it's a good fit for you. Hopefully you guys enjoyed this video. Thank you very much. I'll see you in the next one.